Hello, I'm Bernard Hickey from interest.co.nz and welcome to a special economic weather report brought to you in association with the BNZ. Today we're going to talk about bond vigilantes. Now you may have heard this phrase, it's been around for a while, and they were big in the early 1990s. Many politicians in America became fearful of the bond vigilantes, who essentially were people in the bond markets who sold off treasury bonds when they didn't like what the government was doing with the budget deficit. And when they did that, they pushed up interest rates. And in America, when you push up US treasury bond yields, you also in effect push up mortgage rates. So they had quite a powerful effect on the government, not just in increasing the government's own borrowing costs, but increasing the borrowing costs of all consumers. So bond vigilantes became very powerful in the early 1990s, and they were a factor that drove Bill Clinton to reduce the budget deficit in the United States, in some cases by cutting benefits. But during the late 1990s and through the 2000s, the bond vigilantes were relatively quiet. That's because public debt to GDP ratios fell quite significantly and interest rates were low and kept falling. However, the bond vigilantes are now back. And that's because governments all around the world, particularly in developing countries, have been spending up big time. Firstly, they took on a lot of the debt that banks held or large failing private sector companies held, and that boosted the debt on government balance sheets. Also, governments were spending heavily to try to keep their economies going during the worst of the recession in 2008 and 2009. But now the bond market is wondering, can governments repay this debt or service the debt? And they're asking these questions now of really big economies that are very strong or appear to be very strong. Obviously Greece, we all know about the dramas there. But there are others with this sort of problem, particularly the UK and the US. Both are running budget deficits of over 10% of GDP. Both will see their government debt to GDP ratios head towards 100% in the next 4 to 5 years, unless they change their behaviour. Now this 100% figure is crucial because the closer you get to 100%, the more dangerous it is when interest rates rise and you risk getting into a debt spiral where effectively you're really struggling to pay off the increased interest costs that come through. It means that your economic growth gets restricted and there's a real risk that a spike in interest rates will cause all sorts of grief. So the bond vigilantes start making noises about governments spending too much and borrowing too much, and we saw that over the last week. In the United States, long-term bond yields, particularly the 10-year and the 30-year bond yields for the US Treasuries, rose quite substantially. And this is because there was some big auctions of new US Treasury bonds, up to $118 billion worth. And because the US Federal Reserve has stopped buying these bonds and also mortgage bonds, mortgage-backed bonds, this meant that there wasn't that many other people to buy these bonds, and therefore the price went down and the yield went up. So why does this matter for us here in New Zealand? These are US Treasury bonds that are being bought and sold. And the New Zealand government's debt position is in a much better position than in the United States. We're also borrowing less in proportion to GDP. Why should we care? Well, the global structure of interest rates means that our interest rates are always above US interest rates. So when US interest rates rise, ours tend to rise as well. That means the return of the bond vigilantes is something all New Zealanders should care about. It means interest rates are likely to keep rising through the rest of this year, particularly for longer term fixed rate mortgages. It's going to slow down the economic growth outlook for the whole world and potentially for us, and it shows what happens when the developed world takes on too much debt. Essentially, you have to deleverage, and one way to do that is to have higher interest rates. I'm Bernard Hickey. That's a special economic weather report brought to you in association with the BNZ.